Hey everybody, Dr. Phil here. It's going to be a video on the foreign exchange market in the wider context of international business. Let's go ahead and jump right in. All right, so the foreign exchange market, it's the market for converting the currency of one country into that of another country. It can have a significant impact on the sales and profits of an enterprise. Managers must understand how foreign exchange market works and its possible impact, and of course, they generally do. They have often big companies have whole departments to deal with this. An exchange rate is the rate at which one currency is converted to another. So there's really two functions of the foreign exchange market. One, enables conversion of the currency of one country into the currency of another. And two, provides some insurance against foreign exchange risk, the adverse consequences of unpredictable changes in exchange rates. Have a currency conversion to convert export receipts, income received from foreign investments, or income received from licensing agreements. Number two, to pay a foreign company for products or services, certainly needed for that. Number three, to invest spare cash for short terms in money markets. Number four, for currency speculation, short term movement of funds from one currency to another in hopes of profiting from shifts in exchange rates. And carry trade, which borrows one currency where interest rates are low and invests these in another currency where interest rates are high. What about insuring against foreign exchange risk? The foreign exchange market can provide insurance against foreign exchange risk. A firm that protects itself against foreign exchange risk is considered to be hedging. The market performs this function using 1. Spot exchange rates, number 2. Forward exchange rates, and number 3. Currency swaps. So spot exchange rates, think of this as the rate at which a foreign exchange dealer converts one currency into another currency on a particular day. It's determined by the interaction between supply and demand, and of course, as the name sort of implies, it changes continually. As forward exchange rates is the exchange rate governing a forward exchange. The forward exchange is when two parties agree to exchange currency and execute the deal at some specific date in the future. Forward exchange rates are typically quoted for 30, 90, or 180 days into the future. However, it can sometimes work against the company. Sometimes hedging that far out can be, disadvantageous. And a forward exchange rate contract is insurance against the possibility that future exchange rate movements will make a transaction unprofitable by the time that transaction has been executed. Excuse me. So what about currency swaps? These are the simultaneous purchase and sale of a given amount of foreign exchange for two different value dates. Swaps are used when it's desirable to move out of one currency into another for a limited period without incurring foreign exchange rate risk. So we can think of the foreign exchange market more holistically as a global network of banks, brokers, and foreign exchange dealers connected by electronic communication systems. The market is always open somewhere in the world. If exchange rates quoted in different markets are not the same, there would thus be an opportunity for arbitrage, the process of buying a currency low and selling it high. Most transactions involve US dollars on one side, with the US dollar being, of course, the vehicle currency. The law of one price says that in competitive markets, free of transportation costs and barriers to trade, identical products sold in different countries must sell for the same price when price is in the same currency. With respect to PPP, purchasing power parity, think about what can my money buy, in different places. Given relatively efficient markets, markets in which few impediments to international trade and investment exist, the price of a basket of goods should be roughly equivalent in each country. That's of course not always the case. PPP theory predicts that changes in relative prices result in changes in exchange rates. When inflation is relatively high, a currency should depreciate it, and of course they, excuse me, infamously dubbed this the Big Mac Index, which you can read more about. With respect to prices and exchange rates, for money supply and price inflation, if we can predict inflation rates, we can predict how a currency's value might change. The growth of a country's money supply determines its likely future inflation rate. And when the growth in the money supply is greater than the growth in output, then, of course, inflation will typically occur. But what about empirical tests of PPP theory? It indicates it's not completely accurate in estimating exchange rate changes in the short run, but relatively accurate in the long run. The purchasing power parity puzzle assumes away transportation costs and barriers to trade, which isn't always realistic. The governments routinely intervene in trade and foreign exchange market, maybe a little more realistic, but not wholly realistic. and that investor psychology plays a role on exchange rate movements. So for relative money growth, relative inflation rates, and nominal interest rate differentials, they're all moderately good predictors of long-run changes in exchange rates. These factors, however, are poor predictors of short-run changes. So international businesses should pay attention to countries' differing monetary growth, inflation, and interest rates. Excuse me. And as I said before, most of these big companies have whole, departments that are, sort of focused on this. With regard to forecasting, what might these rates do over time and how far out? Fundamental analysis draws upon economic factors like interest rates, monetary policy, inflation rates, or balance of payments information to predict exchange rates. And then technical analysis uses price and volume data to determine past trends that are expected to continue. Many economists are skeptical of technical analysis, with, I would say, some good reason. And what about currency convertibility? If a currency is freely convertible, then both residents and non-residents can purchase unlimited amounts of foreign currency with the domestic currency. If it's externally convertible, only non-residents can convert their holdings of domestic currency into a foreign currency. And if it's wholly just non-convertible, then both residents and non-residents are prohibited from converting their holdings of domestic currency into a foreign currency. And of course, certainly in the Western world, most of the currencies we would see would, of course, be freely convertible. All right, thanks for watching, and I'll see you all in a future video. Take care.